Good evening, everyone. I welcome you all to the NSE IMF seminar on India's financial system. Before we begin, a humble request to please put your phone on silent or vibration mode. India's US 3 trillion plus economy is set to contribute 15% to the global economic growth and is projected to become the most populous country in 2023. Strong and sustainable growth will not only be critical for the country's economic development, but interestingly has global implications. India's financial ecosystem plays a critical role in its story and is key to credible and equitable growth. In this context, IMF's Asia and Pacific Department book titled India's Financial System, Building the Foundation for Strong and Sustainable Growth is due for release in June this year. The book takes a comprehensive look at India's financial system, setting the stage with the macro environment which forays into banking, corporate debt, ESG, and fintech. It also explores crucial linkages for the financial ecosystem like capital flows, debt resolution, NBFCs, and corporate sector vulnerabilities. Today's program will start with the welcome address by NSE's Chief Business Development Officer, Mr. Sriram Krishnan, followed by a presentation by the IMF delegates on India's macroeconomic financial setting and financial system. The takeaways from the presentation will be taken forward by a panel discussion. So without further ado, I invite Mr. Sriram Krishnan for his welcome address.
Thank you very much. I'm so happy to see this auditorium so full today, and it's such a pleasure to straight away give a live demonstration of the fact that India is the country with the largest population in the world to our visiting dignitaries and friends. A very warm welcome to each one of you today. I have to say a big thank you to IMF first of all for this partnership that they've been doing with us. And in fact, it's the 7th year. We are doing the 7th event in 7 years. It's an incredible achievement. Each time we work with the IMF, we learn so much. So, Dr. Alfred, Dr. Nada, esteemed panel speakers of this evening, and of course, ladies and gentlemen, so many esteemed guests today with us. So I wouldn't want to speak for too long, but I want to certainly share a few of my thoughts. Firstly, I want to, of course, share with you that I joined NSE only about 4 months back. I come from the foreign banking space where I spent about 20 years. But in the short span of time, I've realized that NSE is so much more than just an institution. So if we have to speak about India's financial system, there's no way one can miss NSE in the middle of it all, right? I think, a good financial system is very, very important for any country, for any economy. And a financial system that's robust, that can support credible and equitable economic growth is what every country wants to have. In that sense, I think India has made significant progress in the recent years. It's only fair that some of the progress that we have achieved be spoken about, be shared with the rest of the world in a nice way. And when it comes from the IMF, obviously it carries a lot of weightage as well. And I think we will have our time under the sun when people read the book. So thank you very much for helping us in marketing this story, marketing the details of our progress, and bringing it out in the open. We are a fast-growing country, a developing country where regulations keep changing, and change is the name of the game. And there are so many changes, in fact, whoever comes to India to do business often, speak about it in meetings, in discussion forums, that there are just too many changes we are coping with all the time. But I think that's the enjoyable part of it as well, if you look at it. I mean, a journey without excitement is hardly a journey worth remembering. So I'd like to look at it positively to say that, despite the fact that it's monotonous, painful sometimes, working late hours, working long hours, and making all of the changes, and yet getting a few bashings here and there for things that have gone wrong. It's still sweet when people finally realize that there are 100 things we have accomplished and only a few things have gone wrong. And that's what I think this book will attempt to deliver eventually. There are obviously new players coming to India all the time. You look at the number of foreign portfolio investors we have today, over 11,000 of them. And so many of them have been here for so many years now, investing across a variety of products that we have to offer. And we are also learning all the time from the other countries of the world. And somewhere along the way, we become so good at certain things that, for example, NSE is the world's largest derivatives exchange now for the 4th year in succession. I think we can all be incredibly proud of some of the things that we have also become extremely good at. And credit goes to all our partners, to the entire ecosystem actually. It's not just the financial services space, but India has made progress across the board in a variety of industries and become a top player from being nobody in that space in a very, very short span of time. So the financial system, if one were to look at it, it's very interesting the way we have leapfrogged countries with UPI, which is the 24/7 by 365 system that the government has delivered. And on the back of UPI, the entire ecosystem that's been built further, the India stack as we call it, has made possible so many things. We are now, at a point where getting admitted to a hospital may take less than 30 seconds. So there's a gentleman in my building with whom I go on walks occasionally. So he's a fintech player, and he was telling me the other day that they've built an app. There's a digital health ID that's now ready to be rolled out. And when this digital health ID is rolled out and it's interlinked automatically with the mobile number of the citizen, and in turn with the bank account and so on and so forth, when it gets amalgamated into the India stack, things are going to be miraculously different. So apparently this system has been tested out in a few of the hospitals in New Delhi. And what normally takes about 20 to 30 minutes in terms of the process for one to complete before getting admitted to a hospital will only take 20 seconds once this new system goes live. And the government is extremely happy with the outcome. And the way it works is that if I'm ill, I go to the hospital, put my thumb on the small machine which is there in the reception. That's it. They know me, they know my health record, they know who I am, what's my insurance, where's my bank account. They know everything, and I can directly be treated without any wastage of time whatsoever. So I was like amazed to hear the enthusiasm to see the enthusiasm with which my friend was narrating this whole thing that he was developing. And likewise, if you look around, there are so many fintechs, there are so many startups, 100,000 plus startups that we are talking about, and these guys are working at improving this financial system all the time, improving the ecosystem and making it better and better. So KYC, which used to be a time-consuming process once upon a time, is now taking only a couple of minutes. Accounts can be opened in a couple of minutes with a bank because there is a video KYC process going on. There are so many things in terms of shining examples where I think India has much to offer to the rest of the world. And just the fact that the entire framework is built upon each and every person having an account for everything. That's the construct with which we are working, not pooled accounts like the developed countries. So imagine we have 10 million plus demat accounts in the depositories, which is an astounding number for many other countries when they even hear about it. And yet, 13 billion messages that we get on this exchange many days are processed seamlessly across all of these investors, and hardly things go wrong. So obviously, we're doing a lot of things right and not talking as much about all of those good things that keep on happening well day after day after day. So I think this evening is going to be a session where our esteemed panel speakers are going to speak about some of these achievements and also spell out their thoughts on what we should be focusing on in the times ahead of us. I'm very excited to go through this evening and learn myself. So once again, I welcome each and every one of you here. Thank you so much for your time to be with us today. Thank you to all the panel speakers and to the IMF. In advance, I want to congratulate IMF for this book launch, and very eager to go through this book and learn from it as well. Thank you once and for all. Thank you.
Thank you so much, sir. I now invite Dr. Nada and Dr. Alfred on the stage for the presentation. Dr. Nada Shweri is the Assistant Director and Mission Chief for India at IMF since September 1st, 2021. Prior to that, she was the Mission Chief for Malaysia and Singapore. Her career at IMF spans 23 years, during which she worked on a range of countries in emerging Europe, Middle East, and Asia, and spent several years in the Office of Deputy Managing Director as advisor. While on leave from IMF during 2014-15, she was the lead economist for Algeria and Libya at the World Bank. Born in Lebanon, Ms. Shweri received her BA in Economics from the American University of Beirut and her PhD from Johns Hopkins, US. Dr. Alfred Shipke was appointed Director of the IMF Singapore Regional Training Institute for Asia and Pacific in September 2021. Prior to that, he was the Assistant Director in the Asian Pacific Department and Mission Chief for India. From 2013 to 2020, he was the IMF Senior Resident Representative for China, providing policy advice, leading the analytical work for the office, and coordinating the IMF capacity building activities in China. Apart from holding other senior positions at the IMF, he has taught finance at Harvard Kennedy School and National School of Development at Peking University, and has authored several books and articles. Over to both of you. Let me just... You can use this. So we'll just have the projection.
Thank you very much. Thank you everybody for showing up, and big thanks to the National Stock Exchange for partnering with us to launch this book. Just a few words before I dive into the presentation. This book would not have been possible without Alfred's tireless effort, first to conceive the chapters and then to chase everybody at the fund who contributed to this book. So thank you, Alfred, for that. This book is the collection of hard work by many, many IMF staff across the institution. Also, it's the fruit of collaboration with academia, and it has greatly benefited from comments from the authorities who have helped us improve the content and correct the errors. Of course, all remaining errors are those of the authors. And finally, I should also note that this does not represent official views of the IMF. It represents the views of the authors, so not of the official views of the IMF, of its board, or its member countries. So I will jump into it, give you a roadmap of our presentation. I will give you first an overview of India's macro-financial setting against which this book sits, and then I will start digging into the chapters of the book by covering India's banking sector. Then I will hand over to Alfred, who will look at the changing structure of India's financial system, linkages and supporting reforms, and conclude with some takeaways. So why India? India is clearly having an increasing role on the global scene and certainly in the global economic circles. We have all seen the recent population numbers that have put India at the top of the most populous countries in the world today. And the IMF's own numbers suggest that India is today the third largest economy on purchasing power parity basis. It's also set to contribute 15% of global growth, according to our numbers, in 2023. And last but not least, India has taken over the G20 presidency this year and has set out an ambitious economic agenda for the global economy, ranging from debt resolution mechanisms to climate issues, to discussing digitalization, digital money, and cryptocurrencies. So clearly, what happens in India, what is made in India, has a big impact on the world. And how did India get there? So India has embarked on a range of reforms, a journey of reforms in the early 1990s. And when you look back at the 3 decades that have passed since then, you see that average growth was a robust 6.6% during that time. And over the past 15 years, more than 400 million people were lifted out of extreme poverty, which is really a big feat. Of course, India's journey has not been linear. There has been numerous shocks, both coming from the external front and domestically. And we have tried to list them in this chart, which is in the first chapter of the book. Perhaps I would highlight on the external front the Asia financial crisis and the global financial crisis, which have rocked India and the world alike. And most recently, of course, the COVID-19 pandemic, which has had devastating effects on the global economy and on India. And of course, most recently, not shown in this chart, is the Ukraine war. Domestically, shocks have been both negative and positive. On the negative side, I can highlight the NBFC crisis, which started in 2018 and spanned also 2019, and its knock-on effect on the financial sector. But it's also important to highlight the positive shocks and the positive reforms that have happened in India over the course of the past 3 decades. Most recently, perhaps, the key reforms impacting the financial sector were the introduction of flexible inflation targeting in 2016 and the introduction of the Insolvency and Bankruptcy Code also at that time. So, the history of India, the economic history of India over the past 3 years is a history of significant shocks, but also significant reforms that have helped propel the economy forward to where it is today. And where is India today? For us at the fund, we see a positive near-term growth outlook despite the clouds coming mostly from external shocks. We are projecting growth at 5.9% in the current fiscal year, and it's mostly driven by investment, investment underpinned by an ambitious CapEx program of the government, which we also expect would crowd in private investment as well. On the supply side, growth has been driven a lot by services. India has been a mostly service-oriented economy. In particular, if you see this specific subcategory of services, finance, insurance, real estate, and business services, has been growing fantastically, especially over the past couple of years. That category, however, doesn't employ a big share of workers in India. The biggest employer in India is really the agricultural sector, which is not growing strongly, however. A promising sector could be manufacturing, which has a lot of promise in India, but is not employing a lot of people so far. And here, the financial sector would have an important role to play by channeling credit to manufacturing to make it grow even further and increase employment opportunities in the country. I think the macro picture would not be complete by talking a little bit more about domestic and external stability. On the domestic front, it's good to take stock of where we are on inflation and on the fiscal accounts, which are two important components of domestic stability. Inflation has been high, averaging 6.7% of GDP over 6.7% over the past fiscal year. But the good news is that it has started to decline, and we see it declining squarely within the RBI's tolerance band for the current fiscal year. On the fiscal side, the government deficits have been large. They had been declining prior to COVID, and then COVID threw them off balance. Now the course ahead is for further fiscal consolidation, so to sort of bring back some domestic stability. We see that already in the current budget, which has set out 0.5 percentage points of GDP adjustment in the central government balance. On the external front, the story is really very bright. India's external position has significantly strengthened. Current account deficits have been manageable, but recently they have been even more manageable. They have declined significantly. We are looking probably at a current account deficit under 2% of GDP in the current fiscal year. And the foreign exchange reserves position of the RBI has significantly strengthened. By IMF measurement standards, the FX position now sits above 150% of what we think is needed for a country like India, our metric assessment. So a very strong external position for India. Now, onto the financial sector, which is going to be the focus of our discussion today. The financial sector has gone through lots of hiccups over the past decade, but it has come out in a strong position. And today, when we look at financial institutions, especially in the banking sector, we see robust capital adequacy ratios. We see that NPAs have declined significantly. Today, they stand at about 5% of total credit for both banks and NBFCs. So today, India is in a good space regarding its financial sector, and that is going to be very important to carry growth over the next few years. Why is that important? Where India has a big gap in terms of its financial deepening. When we compare India to other EMDEs, emerging market and developing economies, we see that India still has space to deepen financially its economy, and that will be important to channel investments to the right sectors that can promote the jobs that are needed in India's economy. So given that the financial sector is healthy today, there is a big promise for further financial sector deepening, and a healthy financial sector will promote efficient credit allocation and will go hand in hand with economic stability. So now on to the structure of the financial system. I will focus on the banking sector. When we look at the banking sector, we see that public sector banks still dominate in India. The share of public sector banks in total assets of the banking sector is around 60%. And that's a large share by world standards when you compare it to peers. But the banking sector is also much more diverse than that, reflecting the diversity and the wide geography of the country. And we have some 100,000 regional banks and both urban and rural cooperatives. When you look at the productivity of the public sector banks in terms of the credit that they extend to the productive sectors of the economy, we have a chapter in the book that tries to look at the association between bank credit, firm productivity, and relationships between firms and banks. And that chapter finds that for firms associated with public sector banks, the relationship between bank credit and productivity is much weaker. So this chapter points to the need for reforms in the private banking sector to have it channel credit to more productive firms. And these reforms could take the place of privatization, which is on the agenda of the government, but it also could take the form of improved governance in terms of how boards are appointed and how decisions are made in public sector banks. I will stop here and I will invite Alfred to continue the presentation.
Thank you very much. I also wanted to thank the NSE for the invitation. It's really to be a pleasure to be here, particular at this particular juncture. Now, Nada focused a little bit on the banking sector, highlighting that banks still play a dominant role, and in particular public sector banks. What I wanted to highlight is a little bit the changing structure of India's financial system. Let me see whether this works. It seems to work. One is the rise and increasing importance of the non-bank financial sector. What we have seen is that since 2015, the sector actually mushroomed. Now, why did that come about? On the one hand, the sector is providing financing to underserved parts of the economy, especially the micro, small, and medium-sized enterprises. But I think it's also fair to say that there was a little bit of regulatory arbitrage at the very beginning. What happened in 2015, the RBI correctly did a bank asset quality review, and then as a result of that, tightened regulation for the banking sector, which then led to a slowdown in credit growth. And that space was occupied by non-bank financing companies. So they grew very rapidly. And like in many countries of the world, when things go too quickly, too fast, there's usually also a risk associated with it. And that's exactly what happened in 2018 and 2019. We had the default of two systemically important non-bank financing companies. And this actually becomes almost like a case study of financial sector and real economic linkages. What happened? The two systemically important institutions failed. And then there was a spillover to the rest of the non-bank financial sector. But since they also received credit from banks, there was a spillover to the banking sector. As a result of that, banks started to curtail credit, which then led to higher interest rates, a default in corporates and companies, and that was another spillback to the banking sector, hitting bank assets badly, and then you had sort of like a vicious cycle. Now, as a result of that, the authorities tightened regulation, and basically for systemically important NBFCs and banks, there's somewhat regulatory convergence now, higher capital standard and provisioning. For the smaller ones, the regulatory requirements remain obviously less onerous. Now, you can see here on the figure on the right-hand side, the red part, that's now the NBFC part. So it is and continues to be an important part of the system. Now, the reforms have been implemented. Is there anything else that could be done? And we're of the view that one of the areas where there could be more is the funding sources could be more diversified. Because if you depend on only one funding source, especially when it is wholesale funding, then you can be in difficulties quickly. And the other one is to maybe curtail the lending from banks to NBFCs in order to reduce the linkages, so you don't have potential adverse spillovers. Now, the other part, and this is why we're at the NSE here, is of course capital markets. Now, there has been a lot of development, but obviously from relatively low levels. Let's start with the equity market. India is now the 5th largest in the world. Of course, the volatility is also very high. And when it comes to the bond market, in particular the corporate bond market, there has also been quite a bit of development. And today, the corporate bond market in India accounts for about 20% of GDP, a little bit less than that. But that's still relatively low. And so there is a lot of room for further development. And why is that so important? On the one hand, the corporate bond market can create additional competition in the financial system. And on the other hand, it will provide long-term financing to companies, and maybe even in particular companies that are in the innovative space. Now, what could be done to improve corporate bond markets? There are a few easier and a few more difficult things to address. The easier one is to think about how to broaden investor base, also bring retail investors into the market. The more difficult ones are better creditor rights. That usually requires quite a bit of political capital in any country to change. And of course, anything that improves the market and rating infrastructure. And when it comes to the sovereign bond market, of course, the inclusion of India's sovereign bonds into global indices could, of course, lead to a further or significant inflow, as we have seen in other countries, such as China, for just a couple of years ago. Now, when we talk about the development of India's financial system, and we're looking at standard measures, what are those? A credit to GDP ratio, equity market capitalization, or the stock of outstanding government bonds. We would actually not do justice to what happened in India. Why? Because of fintech, digital financial inclusion, where we have truly seen a revolution. It was only in 2011, not that long ago, that only 35% of the population had access to financial services. Now, how did India go about this? And this has become, I think, a model for many other countries. Of course, through the well-known India Stack, by having biometrical digital identification, debit cards linked to that, and a united payment interface that was already mentioned earlier. Now, other countries have done similar things. Where does India stand out? Two things. First of all, the cost of running these platforms is significantly lower than in many other countries. And of course, the scale, and if you just look on the right-hand side, this is the population that has been brought into the system as a result of the measures. It is really nothing short of spectacular. Now, can we be happy with the outcome? The answer is, of course, not. Part of it is that about 35% of the population still does not have access to financial services and bank accounts. And that, of course, is concentrated in rural areas and among those who are economically disadvantaged. And of course, technology is helping a lot, but it's not just technology. A big challenge here is financial and digital literacy. So again, linking it to the broader educational agenda. Now, when it comes to climate finance, first of all, to highlight that as many countries in the world, climate shocks are potentially associated with large economic and social costs, and of course they can undermine financial sector stability. Now, India has committed itself to reducing carbon intensity and seeking carbon neutrality by 2070. Now, while the financial sector is vulnerable to these shocks, the flip side of that is it can actually play a critical role in addressing these challenges by channeling funds to sustainable sectors of the economy. And here, one of the markets that has really taken off is, let's call it the green bond market or the ESG market, where we've seen both in the equity part and on the bond market side significant developments over the last couple of years. Having said that, though, we're still at the early stages. Now, here the government has set, again, an important milestone by issuing its first sovereign green bonds this year that have been highly successful, oversubscribed, significantly oversubscribed, so that the yield on this is actually was lower than that of sovereign bonds. We call it the greenium, so very, very positive. Now, what is it that one could do to foster the market? And again, that's not unique to India. The key for investors ultimately is to have information about the risks associated. And so the availability of data is critically important. And of course, there are efforts underway to address those. Now, the financial system does not live in a vacuum. It actually is linked to the real economy, the corporate sector, then there are linkages to the external sector, and we're looking at some of these supporting reforms that are needed to let the financial system flourish, and linkages. One of them is to the rest of the world. And Nada already highlighted this earlier. India still has a lot of growth potential. It has a demographic dividend. It still has a lot of room to catch up. So that's the good news. And external financing can help in this. And based on our assessment, external financial sector assessment, we're of the view that a current account deficit, and that relates to the inflows of 2.5% of GDP are financeable. So how has India gone about opening up its capital account? And it did it gradually by starting correctly first with foreign direct inflows, equity, but gradually there's also an easing of restrictions on debt flows. Now, as we know, and we see this also in the figure here on the left-hand side, it's the red dot where we have FDI and flows where the volatility is less, and especially equity flows, the volatility has been relatively high. So as India continues to open up its capital account, of course there is risk of increased volatility, and one of the chapters looks at this a little bit more carefully and comes indeed to the conclusion that what we call capital flow cycles have become shorter and the volatility has actually increased. Now, when you open yourself up, ultimately there can be some volatility. So like the good and the bad at the same time. But how can you minimize the risks of that? An important part is actually related to something that we call communicating medium-term fiscal strategies, so that the market really knows what's coming in the future, and also about reforms that the government wants to put in place. So a communication of that, a clear definition of the medium-term fiscal frameworks could also be helpful ultimately for the financial system. Now, as I indicated earlier, the financial system ultimately depends on the health of the corporate sector. And so in order to get a better sense of that, we did an exercise, what we call a stress test, of companies, so to speak, the corporate sector. And you have different shocks. We used at the time COVID-related shock assumptions, and we had different versions of that, from mild to extreme. But what we could find, two things that are quite insightful. First of all, that the measures that the government put in place to support the economy through loosening of monetary policy and moratoria for companies actually was very, very helpful, minimizing the impact on the banking sector. But even here, with all the support, in the extreme scenario, what we saw is that different types of banks got impacted differently, from foreign banks to private banks and public sector banks. In the case of the extreme shock, it's a simulation, public sector banks would have been below regulatory capital requirements. Another part that is very important is debt resolution frameworks. Again, this is related to companies. In a dynamic world, companies at times fail, and then you need to resolve them to ensure that future credit goes to the right parts of the economy. Think of it as zombie firms. When you continue to finance companies that are basically insolvent, that credit is not available for somebody else. So having a framework in place that allows, in an orderly fashion, the resolution of this debt overhang in the corporate sector is very important. And here we wanted to emphasize again that the reforms that were taken in 2016 through the Insolvency and Bankruptcy Code have really been critically important. Now, there can always be more done. In the areas that we think could be further strengthened is to foster out-of-court processes. It's a relatively quick way of resolving the issue. And in the case of in-court restructurings, sometimes the timelines that exist are very, very tight, so that requires additional resources. And an overall recommendation is to strengthen staffing, including judges and capacity development. It is not only important to have the physical infrastructure, it's also the soft infrastructure, and that's human capital. And last not least, any institutional reform that reduces market volatility is helpful for financial markets because it encourages savers and investment to use financial markets. And here, India's monetary policy communication has played a critical role. India introduced in 2016 its flexible inflation target, and that really has helped in anchoring inflation expectations. And that's critically important for financial markets. And then in our exercise, we also look at whether the communication at the time of the COVID shock, including through what we call forward guidance, was helpful in reducing uncertainty and support asset prices, and the results that we receive were very, very reassuring that they actually have been very, very helpful. Now, monetary policy communication, I would say sometimes is more an art than a science. So there's continuous room for improvement. we believe that maybe more communication about the economic outlook could be helpful, or RBI's reaction function. So let me summarize our presentation. First of all, as Nada highlighted, all eyes are in India, and the world on many dimensions depends on India's economic performance. India has recovered well from the pandemic, and we have entered a period of macroeconomic stability, but I don't have to tell you that there are still risks out there. The long-term economic outlook is positive, given the potential for a catch-up on the economic side, demographic dividends. But here again, the financial sector will be key to channel the resources to the sectors that are most productive. Public sector banks continue to dominate, but other parts of the financial system are growing, including NBFCs. Capital markets have continued to develop, and then India has taken advantage of leveraging digital financing, and the ESG market has taken off as well. On the reform side, we're of the view, and if you look at any international comparison, and this is not ideological, there is probably room to reduce the footprint of public sector banks. That's on the one hand. But on the other hand, you can also further strengthening the governance of public sector banks. NBFCs, important. They have filled the gap. A further diversification of funding sources and reducing the linkages to the rest of the financial system might be warranted. Corporate and ESG bond markets have started to develop rapidly, but it's still early stages, so there's a lot of room to develop it further. And when it comes to digitalization, where India truly is a trailblazer, an example for many other countries in the world, there are, of course, areas where further work could be done, in particular as it deals with digital and financial literacy. On the supporting reforms, gradual capital account liberalization is warranted, but that should go in hand with a strengthening, again, of frameworks, especially the medium-term fiscal framework. As it relates to the resolution of companies that are over-indebted, further developing resolution frameworks, and there's, of course, a bill that is currently being discussed to do that, and any reform that reduces market volatility, including by further strengthening monetary policy communication. Given the importance of India in the world, the excerpt now is available in 8 languages. The QR code should take you to the webpage or the link, or if you just go into Google, I'm sure you will find it. With that, thank you very much.
Thank you, Dr. Alfred and Dr. Nada, for a very insightful presentation. I now request our esteemed panelists to take the discussion forward. Apart from Dr. Nada and Dr. Alfred, we have Dr. Mridul Sagar, Dr. Sajid Chinoy, and Dr. Tidhankar Patnaik on the panel. Dr. Mridul Sagar is a professor of practice in the area of economics at IIM Kozhikode. Dr. Sagar has 3 decades of experience in various central banking functions. He was earlier the executive director RBI, overseeing the central bank's monetary policy and economic research functions. He was also one of the 6 members of RBI's MPC, in charge of taking collegiate decision on policy, interest rate, and monetary policy stance. As also of its FMC, which is the Financial Markets Committee, that takes decision on financial market operations. Earlier, he had served as the head of International Department of RBI, representing at various international bodies, G20 working groups, task forces. Currently, he is also onboarded as an expert by the IMF to render expert advice to IMF member countries in the area of monetary policy. as a part of the IMF mission. Dr. Sajid Chinoy is the Managing Director and Chief India Economist at JP Morgan since 2010. He is also currently serving a second term as a part-time member of the Economic Advisory Council to the Prime Minister. Dr. Chinoy previously served on the Advisory Council to the India's 15th Finance Commission and was a member of the Expert Committee to revise and strengthen the monetary policy framework. To set up the Reserve Bank of India in 2013. He has served on the RBI committees including offshore rupee market and developing secondary market for corporate loans. In 2016, he has served a consultant to the FRBM review committee, which proposed a new fiscal anchor for India. Dr. Chinoy has previously worked at the IMF and McKinsey & Company. He received his PhD at Stanford. His dissertation won the Exim Bank Award for the Best Dissertation by an Indian national for 2001. Dr. Tirthankar Patnaik is the Chief Economist at the National Stock Exchange of India. He has over 2 decades of experience in the Indian capital markets, academic research, credit research in macro sector and strategy, quantitative finance, and consumer banking. He started his career as a researcher at IGIDR and worked on a number of academic and corporate projects, followed by a stint in consumer banking and analytics as an analyst in the Global Consumer Group in Citibank in India and Europe. His next focus area was equity research for institutional clients, initially with Citigroup Global Markets as India equity strategist and then with Religare Capital Market Limited. In his last assignment prior to joining NSE, he was a chief strategist and head of research for India at Japan-based Mizuho Bank. I request Dr. Patnaik to take this forward. And I request all the panelists to join us on stage, please.
Some things never disappoint. The number of times people check their videos before presentations and the number of times people type on mics actually. So, thanking everybody, and I want to thank the IMF team for coming here. My job has been made very easy by the excellent presentation earlier, and I have a long list of questions to ask my fellow panelists, but I also see a fairly, august audience here, and I'm sure they will also have their own questions to ask the panelists. So here's how we would go. I would ask, since Nada and Alfred have spoken now, I would request Dr. Sagar to give his views first, and then Dr. Chinoy, and then we can, I have my set of questions for them, and intermittently I would also request some of you to ask. Dr. Sagar, if we could start with you.
Thank you, Tirthankar. Let me at the outset thank you and the NSE for inviting me to this very important forum. I extremely enjoyed reading the book and impressed because I think the reports, the IMF seem to have moved to the books as a new mantra. I mean, we used to have earlier sort of an apple a day sort of a thing in form of the Article 4 reports once a year, and they seem to be sort of reports which were prescriptory in nature and did not really have the nuance of the political economy of the area. Maybe I'm talking of 15 years back, not now. Things have really moved on from that point of view. And in first week of January, I was in Delhi, where a book of Ranil Saldagho and Rahul Anand were on the South Asia was launched, and I was fortunate to comment on that. And now this book is more focused on India, and I think a read of these two books together virtually gives you all the prescriptions which Article 4 or the FSEP can't give, and it's really packaged in a very, very simple, lucid fashion, which make it eminently readable to everybody, not just technical economists reading through a book. And I would urge all of you to really read when the book is released, and also carry this small excerpts which are distributed today. It's immensely insightful, I must say. So having said that, I mean, this obviously is the high point of book, but it really covers the whole lot of macro financial analysis which we have been reading for last 3 to 4 years, and I almost completely concur with the fund analysis on the issues, including the FSAP 2016, which I was closely involved with. Where do I differ? Now, what more can be out of this book is a legitimate question. And I think one area which struck me about this book, where I have a small difference of opinion, is that I think the word forbearance, the regulatory forbearance, was one I was looking for as a term of analysis. And I found that only once in the book, and that too in the reading list of chapter 4. Actually, if one looks back to what really happened in the Indian story, it was actually the post-global financial crisis regulatory forbearance which set the sort of chinks which grew over a period of time. So the initial hit was the regulatory forbearance which was given, and it came on top of fiscal and monetary stimulus which was never withdrawn in time after the recovery set in post-global financial crisis. And having looked at that, there is enough, not enough, but there is research evidence to suggest, if you look at match firms and bank lending, then clearly banks which benefited out of this whole regulatory forbearance had a direct link with firms which actually had contributed to the bad asset quality. And that sort of thing picked up over a period of time. And though the book very rightly points out the NBFC crisis as one of the major areas where the chinks really came through, if one sees really, that was a manifestation of the regulatory forbearance earlier. And it led to sort of a girlish or kind of increase in the NBFC lending when monetary policy was, the central bank tightened the monetary policy post-global financial crisis, even in some baby steps over a period of time. It eventually turned into a situation where NBFCs substituted the bank credit, and the regulatory the regulation of the non-bank financial companies was pretty weak in that period. I can touch upon it more later in the discussion if time is there, because I think it's important to understand what really happened, and I think it was a regulatory failure on the NBFC parts. So having said this, it's also important that I think the book raises many, many forward-looking areas too, and especially in terms of the digital revolution which India is undergoing, and it's definitely laudatory for sure. And though it is laudatory, I think there are areas of weakness which we need to focus on closely with our lens. I mean, especially when I see that almost 100 million of the 300 million crypto investors, if you see the CoinDesk data, today the data is very dubious on these things, yes, but I mean, what is reliable the most, probably the CoinDesk has a good amount of investor base to tell us. 100 million out of 300 million crypto investors coming from India does worry me. I mean, which sort of make me wonder that should we only be lauding our digital, or also be looking at these gaps which are emerging very closely, and we still haven't regulated the areas where we should be regulating it very tightly. But for paucity of time, I will leave it here, and Sajid, I'm sure, is kicking to say with the help of some slides. So I'll allow him the time, but I will come back on some of the issues I have
Certainly,
raised.
certainly, Dr. Sagar. I just wanted to say, I mean, we saw the book in 8 languages. Why really can't we have the languages in all the vernacular languages of India? If it's possible. So, at some point, not now, maybe at some point. Sajid, if you please. I think you could go in presentation mode.
Well, let me start by thanking Tirthankar and NSE for inviting me today, and start by congratulating Alfred, Nada, their co-authors, co-editors, Yarko and Anne-Marie, for a fabulous book, I would say, at the right time. As we were discussing in the green room before this, the financial sector has gone through a real roller coaster ride, as many of you know. This big boom, credit boom between 2007 and 2013. As with all booms, there were excesses, and then we had to clean up after that, and we've had to go through the 4 Rs over the last decade: recognition of non-performing assets, restructuring, recapitalization, and hopefully some reform. And we've just begun to see the benefits of that decade-long process. So I think the book is perfectly timed, and I think the macro financial linkages are crucial. What I'm going to try and do over the next 4 or 5 minutes, I know Tirthankar said to minimize slides, so I will, is just to try and lay out why the macro financial linkages in the book are so relevant and important for India today, given our macro position. And I'm going to start by putting all of this together in the context of private investment. I think all of us will agree that as the economic recovery from the pandemic has deepened and broadened, and we think of a post-pandemic world, that fostering a private investment cycle becomes critical to growth prospects over the next 5 or 10 years. Nada spoke about the fact that there's public investment that we expect this year, and hopefully that will crowd in private investment. But I think that's the starting point. Now, if you look deeper into where the slowdown has been, there's this common perception that slowdown is all in large corporates, and we're all waiting for large corporate investment to pick up. But really, if you go back the last decade, the slowdown has actually been among households and SME investment. And this is why the health and structure of the financial system matters so much, because to the extent that you need to jumpstart SME investment, the changing structure that Alfred spoke about, the fact that you've got more NBFCs now, the fact that you've got more digitization now, so that the asymmetric information barriers are less, adverse selection problems are less, could well be a crucial factor in jumpstarting SME investment in this post-pandemic world. So if you take the lens of why investment is so critical, you can't but think that a healthy, diversified financial sector is crucial to this investment cycle. Just to, as context here, I spoke about the fact that we've had deleveraging over the last decade. Corporate debt to GDP in India is now the lowest since 2006. But the constraint, the binding constraint for larger investment, one would argue, has now moved from balance sheets, which have been resolved, to utilization rates and demand. That if you look at this is the RBI's Abacus survey that Midul, I'm sure, is very well aware of and quarterbacked, that utilization rates are still in their early low 70s, right? And so to the extent that you're living in unprecedented uncertainty and utilization rates are still early 70s, it's no surprise that a broad-based large capex cycle will take time. Now, the reason I say this is, one, because we can say, well, the financial system is very healthy, and then we can wonder why isn't there more credit deepening? And so there's an identification problem there, and we should recognize that even as the supply side has improved and become more healthy, there is perhaps a demand side that we need to address, and it's only then that you can see a more broad-based credit pickup. Now, to be fair, credit has picked up and picked up smartly. The left-hand side is a little bit deceptive. Credit growth in nominal terms is running at 15%. It may seem shallow compared to what we saw in 2006-07, but that was clearly over-lending. That was irrational exuberance, which led to some of the problems. And so if you look at this year's credit growth, it's the strongest since 2012. But I would argue that hasn't resulted in credit deepening per se. Nominal GDP this year is almost 16%. So credit to GDP, the left-hand side chart, is actually still, lower than where we were in the middle of that decade. And I would argue, therefore, that the private investment cycle needs three prerequisites, and I'll end with that. The first prerequisite is this, healthy, well-performing financial system. That the typical rule of thumb in India is that credit growth needs to be some multiple of nominal GDP, 1.2, 1.5, right? And we haven't seen that multiple play out for much of the last decade. So the real test of the health of the system and the improvements in the last 3 years, better, low NPAs, more recapitalization, NBFCs that are healthier today, more digitization, less asymmetric information, will come when the demand for credit and the demand for a capex cycle picks up, and it is left to the financial system to service credit demand of 15, 16, 17% credit growth, which you haven't seen in a decade. Right? So for me, I would say that's the true test. That's when the rubber hits the road, that when utilization rates go up, hopefully they will soon, you get some sort of capex cycle. How equipped and prepared is the financial system? I would argue, my hypothesis, my prior, is that the system today is much healthier. That the combination of much lower NPAs, much greater capitalization, resolution frameworks, the diversified structure that Alfred spoke about, are all ready to support a capex cycle. But that's not the only prerequisite. A second prerequisite, and the book touches upon this, is fiscal withdrawal or retreat. I think all of us argued that emerging markets had to do what was needed in the crisis, but we now, and no one is making the case that there is crowding out today. In fact, it's quite the opposite. If you look at the corporate bond market and you look at the compression of yields in the 10 to 30-year horizon, what you have is a lot of contractual savings and pension funds, insurance funds looking for places to invest. There isn't enough of a supply of corporate bonds. They're therefore forced to buy government bonds, and that those spreads have compressed dramatically. But the question is going forward, if we were to see a capex cycle, it will have to be accompanied by progressive fiscal consolidation for this to be sustainable. And why do I say this? Because of the twin deficits. That if we think of the current account deficit in India, this is nothing but the investment savings gap of the economy. And if you break that down into the investment savings gap of the public sector and the private sector, you can see the two lines on the right-hand side chart. That the private savings investment is in surplus, and those surpluses have grown because of the lack of investment the last decade or so. The public savings investment is in a deficit, what we call the public sector borrowing requirement, and that is understandably increased. But as an investment cycle picks up, you should expect to see the orange line reduce, and that will be a healthy thing. That you will see private investment pick up, savings will be channeled towards investment, and the SI line should come down. Now, the only way that can happen without making the current account unsustainable is for public sector borrowing requirements to come down. So I think when we think about what are the prerequisites to an investment cycle, number one, it has to be a healthy financial sector. Number two, as the book alludes to, it has to be medium-term fiscal frameworks and reducing the fiscal deficit so that you can have a domestic capex cycle that does not spill into an unsustainable current account deficit. Speaking of which, my last slide is we've seen massive gyrations in the current account deficit. 2 quarters ago, we were close to 4% of GDP. We're now, the last quarter was likely a modest surplus. But even as the balance of payments in India is now very healthy, war chest of reserves, nothing to worry about at all. One slightly disquieting phenomenon that all emerging markets have seen in the last 9 months is a slowdown in FDI. Right? And India has been no exception to that. You can cut it any which way you want, and FDI has slowed. And so looking forward again, projecting over the next 3 years that a capex cycle picks up, that will result in a current account that's 2.5% of GDP, as Alfred and Nada pointed out to, which is sustainable. I think a third objective will have to be to fund that safely. And we saw the charts on volatility. FDI was among the least volatile, and therefore to increase India's share of FDI, whether it is through opening up more FDI sectors for more FDI, whether it is through realizing the promise of China +1 so more FDI comes here, so that again you can have domestic capex cycle, you can have a current account that's 2.5% of GDP, and you're not left exposed to highly volatile capital flow. So I just wanted to place in context all the different elements that the book speaks about so well. The need for financial system to be healthy and clean, the need for a medium-term fiscal framework, the need for capital account liberalization that's gradual but to increase safe capital flows, and say that all of those three elements are the three legs of a stool that India will need to jumpstart and sustain a private capex cycle over the next decade, which is why this book I think is so important and a must read at this point in time. But I'll stop there. Thank you.
Thank you. I think the points that you made about the first order condition being right in terms of lower NPAs, and the second order condition that we are seeing now in terms of improving demand. If I could go back to the book, and ask Alfred Nada about what did India do right in terms of controlling NPAs, even through the pandemic, capital levels are under control, and what are the sort of learnings for the rest of the world?
I think what the book shows is that there were amazing amount of reforms, right? Alfred spoke about the introduction of the Insolvency and Bankruptcy Code. We showed how NPAs have declined. Sajid's charts show the corporate deleveraging. So the important reform process that has happened over the past 10 years is really what has enabled the financial sector to stand on its feet today. But having said that, as we show in the book, this is not, it's not the time to just sit on your laurels and say the work is done. And there is much more work to be done in all the areas of reforms, in either reducing the footprint of the public sector in the banking sector, or improving the governance, improving the way these banks operate. This is one thing. And second, improving the frameworks for banking resolution and for bad asset resolution as well. These the regulations that were introduced in 2016 and the establishment of the National Asset Reconstruction Company in 2001, these were all very good steps, but we need to see them work better. So we need to see more agility in the system, as Alfred said, more resources put into it, facilitating even more the way these frameworks operate. So as an example, the reform of the Insolvency and Bankruptcy Code, there were some steps that have happened after 2016, which Alfred alluded to. One of them is the pre-pack route, right? The fast-track resolution outside of the court system, and then bringing it to the court at the last stage. And that we have not seen a lot of pickup of that route. So why is that so? So there has to be a study looking closer at this and to see what is happening there. The good news on that one is that the Ministry of Corporate Affairs has put out a paper for discussion earlier this year to tackle some of the Insolvency and Bankruptcy Code reforms and see how this fast track can be speeded up, how it can be broadened to more companies besides just the narrow MSME range, and how voting rules can be streamlined so to facilitate a resolution. So these are, some of the areas where more could be done. There, I don't know if Alfred.
These are things. Do you see these reforms as having precedent across the world earlier, or is India doing something that's blazing?
I mean, these are reforms that have happened everywhere. We have seen, banking stresses, banking turmoils in many countries across Latin America and other emerging markets in Europe, and the course charted for these types of reforms have happened elsewhere as well. I wouldn't necessarily say that this is something really difficult or novel to do. I think where I would highlight novelty in India is on the digitalization front. I think the way India has taken over digitalization, and through the involvement of the public sector, but also private-public partnerships, and putting together these public railways to enable the private sector to come and innovate and operate, is something unique that India can offer to the rest of the world.
Maybe I could just add one word where maybe India in this part of the world, which is Asia, I think in general, might be in a very different position than other parts of the world. And I only realized that over the last couple of years, you all live in a world where growth is 6-7% a year. For some of you who study economics, you all know the rule of 72. That means, if you grow by 7%, every 10 years, the economy doubles. The financial system, financial deepening, means that the financial system develops even more rapidly. Now, the reason why I'm highlighting is the challenge for regulators to constantly upgrade the policy frameworks and regulation. Because even if you had a perfect system today, in 7 years, completely outdated. And I think sometimes we all don't recognize that countries that have these high growth rates, which is a fantastic story, but they inherently raise the risk that regulatory frameworks and ultimately supervision lags behind. And then on top of that, it's not only the size of the system, the structure of the system changes. Now, we have talked a little bit about digital. One can, of course, have an entire event of this. But there are also new risks, whether it's consumer protection and other areas, where ultimately there has to be effort, because once confidence is lost, it's very difficult to reestablish. So maybe just to highlight that one of the difference of this part of the world compared to places that grow by 1 or 2% a year, for regulators and policymakers, it is a true challenge.
I see two segues from the discussion. One would be, the changing regulatory framework that Alfred you spoke about, and it kind of links with my question to Mridul on NBFCs. You did mention, here that regulatory forbearance was one point which was something that needed to be highlighted. But if one looks at, from the prism of Alfred, we had a rapidly growing economy. We had a place where public sector banks stepped back a little bit, NBFCs stepped in, and there was rapid growth, and it was also regulatory evolution. So my question to you would be, what kind of regulatory frameworks would you see today for the NBFC space? And of course, you could bring in your point on regulatory forbearance as well. And how should we see these things panning out forward?
Sure, Tirthankar. I think this is an important element, because today the NBFC sector is almost a third of the size of the banking sector, and bank-dominated financial system. So that's a bit of changing two ways. One, the NBFCs increasing in size, the other, markets increasing in the size. So direct disintermediation, markets channeling financial surpluses to the financial deficit entities. So this is something good. It's not necessarily bad. It adds to the diversification of the system. But there are lessons to be learned, as Alfred was saying, about the structure and the complicated structure when sort of economy goes so fast and stuff. And that precisely happened with the NBFC crisis of 2018. I mean, if I look back to the 2018 ILFS crisis, I mean, there is absolutely no doubt to my mind that it was a complete regulatory failure, because you had 256 group companies working under a core investment company which was registered by the regulator. And the regulator, for some reason, believed that the core investment companies is just putting assets on its balance sheet because it's investing in other group asset companies. And there is nothing to worry about that, and you should be supervising the rest of the NBFCs. Now, this was a fallacy which completely got blown apart, because the group companies were lending to one another a small amount of networked lending and further leverage by another of the group company. So together, when this leverage was building up with one after another company, the total leverage of the ILFS was a whopping 16. I mean, the gearing ratio was 16. I mean, I haven't seen hedge funds, many having that kind of a gearing either. So it was really not thought that what is happening on the liability structure. But a crisis is never wasted, and the regulator did learn lessons from that crisis and put in place a lot of remedial measures. I mean, firstly, it brought core investment companies under supervisory lens in a very solid fashion. Second, the gearing ratio was clamped down completely. Now, many would argue, okay, this has choked credit and stuff, but this was something which was necessary. I mean, see, credit would follow on a more stable footing once you have the system in place. But you can't really have this kind of a lending. Of course, today also India has a negative credit gap. If one sees the credit gap, really it's minus 12% if you do the HP on the credit to GDP ratio. So basically, we are under lending as a system. So we need to expand. But we can't expand just by proliferating credit mindlessly. I mean, you have to have bankable projects, you have to have a proper regulatory system, and then expand credit. Otherwise, we are just going to blow that up in many fashions. So the regulatory failure was not just on the side of the NBFCs, but also on the side of the rating agencies. I mean, it was pathetic to see ILFS bonds. I remember those days. We were stunned that it enjoyed almost, it did enjoy AAA rating by two of the credit rating firms. And within a matter of a month, it was downgraded to a junk. But what is the point of a credit rating if you do that after the event of a default occurs? So clearly in India today also, shopping for credit rating goes on. And you need really much tighter rules on the credit rating front. And this is something especially which matters on the equity sides, and I'm raising it in platform here with the hope that there is more cognizance of these important facets of things. So let me sort of leave this at here, but going forward, I think the biggest plus which the regulator has now done out of the crisis, the lessons learned from the crisis, is the scale-based regulatory approach to the NBFCs. And I think this is practical, feasible, because the extent of NBFCs which exist in India, it's just not possible if you don't do scale-based regulation. I would also urge the regulators to use more of RegTech, SupTech, more kind of quantitative models for regulation than on-site inspections which don't really yield much. So your focus has to be strengthening corporate governance, your focus has to be strengthening basically the more modern way of regulation rather than just the number game about the regulation. And that will put the macro financial stability on a much more firmer footing to my mind. So let me leave it here.
So, I mean, we did speak about NBFC lending. The other part of lending that has not really picked up yet, and it came out in the presentation as well, was on corporate bond markets. So, but before I ask Sajid you that question, I would like to ask the audience, two questions from the audience very quickly for our esteemed panelists. What do you have after the the presentation? Yes, sir. Please. Quick question, please.
First of all, I would like to congratulate you and wish you all the best. My question is that you spoke about India's economy probably before 2023 or what was in the past. What I would like to know is that a significant amount of corporate profits in India is contributed by companies which were formed probably before 2000. So they are probably 30, 35, 40-year-old companies. So the next coming, say, till 2030, or when they say India will be a 50 trillion economy by, say, the 100th year of our independence, where do you see the corporate profits coming from? You still think it's going to be the same Reliance and HDFC banks, or maybe ONGCs, or you think that the new age companies probably would be forming a significant part of the corporate profits?
Contribution to corporate profits. Any one more question? We can take both the questions together if that's all right.
Question is, there was a recommendation by Alfred that share of public sector banks should be reduced. Some takeaway or somewhere it's written, share of public sector should be reduced. I didn't find what is the reason or what is the reason behind that.
Thank you, sir. So, who would like to field the question? I mean, what kind of companies do you see? Am I audible? Good exercise. So, clearly, I mean, if I can take a stab at answering that question, clearly, old economy companies may not be the ones that will take us to the next side of to the next decade or so. Today, the technologies, the drivers of the economy are very quickly changing. 20, 30 years back, I can give you the example of the US. I mean, in the 1990s, the big companies were around Detroit. They employed 1 million people, and their market cap was, it added up to slightly less than $1 trillion. Today, you have, 30 years later, you have companies that employ a fraction of those, of that number, maybe 120, 130,000, and with their market cap, a multiple of that number. So for India, the drivers of our economy will definitely change. I do not speak about specific companies in India. Let me just tell you about, what were the contributions of our sector, since we are in a macro presentation. Back around independence, we were about 45% by agriculture and about 28% by industry, and the services was fairly small. Today, agriculture is about 14-15%. Everything else has been taken up by services, and in these services, obviously, when one drills down, it gets into corporates. So you will have new technologies, you will have newer companies that work into these technologies. You may not have labor as a component as much as what you have as technology, but clearly one sees a significant change in my understanding of the corporate composition of profits for the next decade. The next question on public sector, please. Alfred, yours.
Let me just clarify. So the points that we're trying to make is that our analytical part suggested that the credit that comes from public sector banks goes to large corporates, and they tend to be less productive than the credit that goes to the private sector. One of the conclusions would be to reduce the number of public sector banks. Now, this is not about ideology, because at the end of the day, it's the corporate governance. A private sector bank with bad corporate governance can be worse than a public sector bank. It just shows that in the current context, India really stands out, as do other countries in Southeast Asia, in terms of the share of public sector banks as part of bank assets. The global average is significantly lower than in India. So our recommendations are twofold. Again, first, improve the governance of public sector banks, give the board more independence, and maybe at the margin also allow the RBI, which has the power to remove boards of private sector banks, to also potentially remove boards of public sector banks. And the other one would be, I think India does have room to have a larger share of private sector banks. But again, this is not about ideology. This is about the data and the governance structure ultimately.
Thank you. I just want to add to what Alfred was saying. I think he has nuanced it very beautifully. I mean, this is a long-standing public debate, public policy debate about the structure of banking in India. Now, clearly, you had the PJ Nayak committee report, which virtually asked for repeal of the Nationalization Act and the SBI Act, and which basically meant that no public sector bank should exist. We have another model which someone like Arvind Panagaria has been arguing for, that you should have SBI as the only public sector bank and the rest private sector banks. And while this debate will go on, I think a more nuanced way of putting it is that you should have a more balanced structure by sort of having some consolidation in the public sector banks so that they can reap scale and scope economies and be efficient in nature. And yet it should not be as dominated as it presently is. Now, the crux of the problem, as rightly put, is the governance in the public sector banks. I mean, I have no doubt that the public sector banks are making very useful contribution to the economy. If you talk to someone like Rohini Burgess and Rohini Pandey, who heads the Columbia School option, so she has shown that the public sector banks actually reduced poverty and inequality by lending. But every period, there is a period some policy is right, period some policy is not right. So the transition has to be made, and I think the time is right to make that transition to sort of increase back the private sector banks because governance reforms really haven't happened in true sense in the public sector space. You had the bank board bureau set up, but practically I don't think it's working very independently functioning at the moment, and we don't have the requisite autonomy with, to the boards of the public sector banks. The FSAP of 2016, the Financial Sector Assessment Program report, which the IMF does, I would urge you all to read back. A lot of it has been implemented, but on the regulatory power, it came down very heavily that it's not the same. So while supervision, we try to be agnostic to the structure, ownership structure of the banks, the regulation powers are very, very asymmetric, and that needs to be corrected to my mind.
Thank you, Dr. Sagar. Dr. Jinoy, why and how should we improve our corporate bond markets?
Before I answer that, just 10 seconds on the last two questions. On, when we talk about what will the structure of firms be, the question is, what is the policy implication? And it's nobody's case that you should have a central planner deciding what the sunrise and sunset industries be. I think the implication is that the system should allow for rapid creative destruction, right? That in a world where there's so much technological change and things are happening so rapidly, these things are going to move rapidly. What is a sunset industry? What is sunrise? And the goal of a policymaker is to make sure that capital is not locked up for long periods of time. That capital and labor can move quickly from one sector to another, from one firm to another. And I think therefore the bankruptcy code was so important in that process. I think we have to also think about it from a labor perspective, right? What are the jobs for the future? How can people be skilled and educated so that they can quickly move from one industry to another?
10 seconds more on the public-private sector debate. See, there's a difference between de jure and de facto, right? The fact is, de facto, the stock of assets for public sector banks may be the majority. But if I look at flows, private sector banks' credit growth has been, for the most part, consistently stronger than public sector banks. So de facto, the share of the private sector is increasing, and this is going to happen organically over the next 8-10 years, that their relevance will become more important if public sector banks don't reform and reinvigorate and lend. On the corporate bond, what is the old joke in India? The answers never change, but the questions do. We've discussed this 5 years ago, 10 years ago. Let me just say, why is it so important? I think it's important because when Alfred motivated his discussion by the fact that the financial sector was in some levels of stress between 2010, 11, 12, why did that happen? Because you had all this infrastructure lending that banks were ill-suited to undertake because of huge asset liability mismatches. Now the government has correctly taken on infrastructure spending on its budget. But there are always fiscal limits, and at some point, given how yawning the infrastructure gap is, we will need the private sector to invest again. And at that point, we don't want to make the same mistake as the past, where banks are lending. You want an arm's length corporate bond market where you can borrow 10 years, 15 years, 20 years, 30 years to finance long gestation projects. So it should be very clear why we need that corporate bond market. Now, I think what's been very encouraging in the last 10 years is contractual savings have picked up a lot. So we used to bemoan the fact that insurance, pension penetration is very low, and that's really picking up. So now there is an investor base that's looking to invest 20-year, 30-year money. And what's happened over the last year? They've bought government bonds. The puzzle over the last year has been, why is the yield curve so flat beyond 10 years? Because there's so much demand that insurance and pension have for those gestation assets, and there isn't enough corporate bonds being issued. Now, why aren't there enough corporate bonds being issued? It comes back to the age-old issues, right? Market microstructure, creditor rights, right? Resolution frameworks. And what you see in the market, at least, I sit close to a trading floor, is that there is this huge dichotomy between haves and have-nots. The best firms are flooded with options. Banks want to lend to them. They can issue a corporate bond at a very small spread over a GSEC. They can borrow through external commercial borrowings. Right? If you go down the credit curve, that's where people have trouble. And that comes down to the information asymmetry, concerns about adverse selection, concerns about creditor rights, concerns about ratings agencies not doing their job to the point Mridul made. So I think it's that plumbing that we need to fix, right? Because one part of the equation is working out correctly. You've got contractual savings. It's that plumbing on the other side that increases the confidence to go down the credit curve that needs to be worked on.
Just quick rejoinder to that one. Why has the policy response always been creating champions? National champions. You have as many. You had DFIs earlier, and then you have setups that the government thinks would basically lead investment in this sector.
In the financial sector,
long-term funding, which will basically issue long-term paper, and then pick up that asset.
Well, I think that's filling this gap, right? That because there isn't a corporate bond market that's healthy and functioning to finance gestation projects.
That's why my question was: do we improve the corporate bond market, or do we, in the interim, create these champions?
My answer to this is always, in many contexts, India is such a large country. It's never an or. It's always an and. Should it be manufacturing or services? No. We need both. Do we need small firms and large firms? We need both. I think for the finance sector, it has to be let 1,000 flowers bloom. So we'll need, given our needs, a corporate bond market, maybe some DFIs, banks, NBFCs, the whole suite of products to service the different needs.
Very fairly put. Very fairly. Yeah, at this stage of the discussion, I would be amiss if I don't ask a question on climate change. One of the things one sees that if we've had our net zero commitments by 2070, there are numbers that India would need about $10 trillion in terms of funding. So climate finance over the next decade or so, certainly to Kush's point, will become quite a big deal for countries like India. So what do you see, Alfred? How do we see improvement in climate finance? You did mention that sovereign bonds, greenium. You did mention the existence of a greenium, but we do need to multiply. get an enormous amount of funding. How do you think we should go about it?
Maybe I should just highlight this is a challenge for almost any country in the world. The resources that will be needed to do the shift that I think the global community intends to do the need is almost unlimited. In the financial sector, I think, and the IMF came out with a study, it's called the Global Financial Stability Report in 2022, that also speak that we need new instruments. We can't just go with what we have. Of course, again, as in India, the government can take a role by creating a yield curve for green bonds, and that's an important step. But there might be other instruments like outcome-based debt instruments that are linked to sustainable linked bonds, for example. So we have to really be creative, look at the obstacles. It is, of course, not surprising that compared to some of the advanced economies, green bonds, for example, in emerging market and developing countries are at an early stage, but that has to do with the fact that the market itself is underdeveloped, right? The lack of liquidity in the market is not only true for the corporate bond market, is also true for the green bond market. So anything that helps on the corporate bond market at the end of the day also helps the green sector financing. But I think you're right, this is truly a challenge. How do we get these massive resources to the sustainable sectors of the economy? But this is not limited to India. This is truly a global problem, only amplified by the fact that markets are less developed and therefore a big push is needed.
Nada, I had two segues to the points that you made earlier. The second one was on digitalization. So, the way in which India has gone about digitalization, we saw this stupendous graph that Alfred showed, that from 2011, from near zero in terms of Aadhaar numbers, we have now over 1 billion such numbers, and we have UPI. Retail transactions was something that even Mridul mentioned. What's the sense that what's your sense of how India has gone about this journey?
Yes, I mean, as I mentioned earlier, and as also Alfred covered in his part of the presentation, the digitalization journey of India has been truly remarkable in how it has enabled financial inclusion, social inclusion, also on the health sector. We heard in the open remarks that were very informative, how it has enabled efficient government function, the transfer of direct benefits to the population during COVID, very rapidly reaching people. And also how it has enabled the government to collect revenues much more efficiently and bring people tax net. Now this has been a transformative journey, but it's not a complete journey. And I think Alfred pointed out to where more can be done to take this journey everywhere within India to benefit everybody. We have observed that there is a digital divide, which is along the usual lines that you would expect: income faults, the gender faults. So there is a need to bring the digital knowledge to all segments of the population. There's also access to internet is not everywhere the same within India. So when you look at urban and rural areas, urban areas have manifold more access than rural areas. So one thing we've discussed with the government, and of course they are aware of these. So it is a journey to complete the digital transformation. There is an effort to have public access to internet enabled everywhere within the territory. There is also, an effort to have an education campaign. There's also an effort to, for example, have UPI accessible through, regular phones and not just smartphones, feature phones. So there are efforts underway to take that.
Anyone else wants to pitch in on this, on the digitalization journey?
Reinforcing the same point, like this is a stellar story based on UPI and the low cost payments which India is making a huge digital transformation. But let us not underestimate the challenge which is involved here. I mean, for India, the digital financial inclusion has actually contributed a small proportion to the total financial inclusion. I mean, basically, if you see the hard statistics, it's basically the bank account opening which has led the financial inclusion. Today, 77% of the adults have the bank account, 15 plus as per the Findex database. Now, the good part is both men and women, the number is the same. So there's no gender inequality in it. And that's an astounding feature from a emerging market. The bad part of it is when you see the digital part of the data, actually say merchant payments on the mobiles, it's just 8% for India, it's 82% for China. I mean, so let's not say that we are all at our best. I mean, there is still a lot to be done.
I think Nada made that point. I mean,
yeah,
Nada made that
point,
yes.
exactly. And so that's very important that we don't lose sight. We haven't used the digital payment except from the deposit side. We really need to do more. The good part, which in fact Nada was telling me earlier, was that the government has done a lot to improve efficiency out of the digital payment, and I fully agree, like the way the direct benefit transfers and other things are going on. But there are lots of gaps in the digital area.
On this, I have some, inspiring statistics as well. 77% of us have bank accounts, but if you look at PIN codes in India, so banks reach more than 99% of all PIN codes. Actually, markets also reach more than 99% of all PIN codes. There are only about 35 or so PIN codes which out of the 125 or 1000, I think that's the number Smriti had told me, that are not yet touched by market. So, in terms of outreach, in terms of reach, it's very, very significant. I have, one juicy question for, of course, we have an ex-MPC member here. I have to ask him this question about flexible inflation targeting. Alfred absolutely also said that, with better communication, we've had, lower volatility, we had, more information from the central bank. What do you think could be done better, Dr. Sagar? And this is before we open up. I know we are past our time. We'll open it up for a few questions from the audience.
So, the hat doesn't leave me, but let me sort of say it now from outside the hat portion. I mean, I think your question was more on the forward guidance part or communication part.
What could be done better?
Okay, but book talks a lot about communication, so I thought it stemmed from that. But what could be better? A whole lot of things can be done better. I mean, it's not bad. I mean, the inflation targeting regime was introduced in 2016 and completely transformed the way the monetary policy was conducted. And let me give it all credit for anchoring inflation expectations in India. Maybe not so much the inflation expectations, which completely never got anchored because there was always this issue that how much output sacrifice can a country make to get inflation down. But it did get inflation down from double digits to an average of 3.9% in the pre-pandemic flexible inflation targeting period. And that's not a mean achievement by any means. And the volatility also was not very high, so though it could have been lowered even more. But a couple of things about the forward guidance part which comes from the book. And while it looks that it's a great success story, we have to sort of temper that sort of feeling that we did something very great because it also had its attendant cost. Yes, the forward guidance succeeded in keeping the G6 yields low for some period of time, but the benchmark yield could not be held back to 6%, which initially was seen as implicit sort of a target, and there were auctions bouncing out of it. So it was not a seamless transition of forward guidance. And that's not the Reserve Bank story. I mean, the story is all over the world in much more extreme form. You look at how Reserve Bank of Australia had to abandon the yield curve control. You also have to see how Japan is struggling now to get out of this yield curve control and sort of get back into a policy rate target, which one hopes later in the year it will be able to introduce in some form. So I think central banks should not go overboard in trying to sort of placate the markets. There was the period of extreme shock in March. Yes, everything needed to be done and was done in time by the central banks. And I really give them full credit for saving the day, because otherwise the financial market meltdown would have had huge attendant cost, and we would have either a global financial crisis if we were lucky, and if we were worse, it was a global depression, as straight as that. So we could avert both of them because of all this, including the forward guidance which was initially given. But these are extraordinary measures and should not be repeated, actually, because it adds to complacency of the market, and least of all, a time-based forward guidance. Let me be very blunt here that the time-based forward guidance have huge cost in terms of policy recalibration when it is required. And today, if central banks have fallen behind the curve, they of course came back and caught up with the curve, but it had a lot to do with this forward guidances. The Evans rule never even took off, I mean, in the Fed. So they had to completely abandon and go back on it. I'm okay with some sort of state dependent forward guidance, but that too should be limitedly used. I think the burden sharing has to be there between the central bank and the market. It's not the job of the market. It's not the job of the central bank to sort of completely support the fisc, though fiscal monetary coordination is important, especially in extraordinary times. But as recovery set in, the sooner the exits would have happened, it could have costed the economies a wee bit less.
I just want to make a broader point, not about the RBI. You know, every week you hear a clamor about what new objective we want to burden central banks with, right? So it is growth, it's inflation, it's the yield curve in some cases, it's financial stability, it's inequality I hear sometimes in the US, in the US Senate. There is now green finance, and we should just go back to 101, the Tinbergen principle. You have to have as many instruments as you have objectives. And we have to be humble about how many orthogonal instruments central banks have. And start by there to say if there are two instruments at best, you can have two objectives. And so I get very nervous when, for all central banks in the world, you're being, you become the lender of first resort, not last resort, and you're tasked with more and more objectives. I'll just say one other thing about forward guidance. Perhaps what EMs can consider to the point of state-based guidance is maybe kind of a dot plot like the Fed has, right? Because what that does is it gives you state contingent outcomes. That if you believe growth is going to be this 4 quarters from now, and you believe inflation is going to be this, then you think policy rates are going to be here. And in markets which are much less liquid, and therefore there's much more intraday and intra-week volatility, it may not be a bad thing to have more quantitative state-based guidance, because then you're not tying your hands, and you're still giving guidance that markets can use down the road.
What we are left with is a composite view, which does not give the level of information or detail that's required.
And this is true for all EMs. This is not RBI. That maybe a dot plot going forward can be an intermediate solution between these two.
I think what Dr. Sagar said about this time-based, the limited time forward guidance and then trapping central banks can only be resolved through, state-dependent forward guidance, and be very clear about the framework within which you operate and what models you have and how these models, can adjust to the reality as the reality adjusts would be very helpful.
Is it difficulty of communication? Because you do hear thoughts that future decisions would be data based on data. Are we not getting a composite view of what is actually state dependent guidance?
I think it's almost a gospel truth that it should be data dependent, and that one should accept it as that. The issue is what are the uncertainties attached to the forward-looking data? So can we predict it with reasonable confidence or no? And as Sajid and Nada have already said, that dot plot offers a solution to that in some respects. I think that's where the importance lies. So, I mean, whether or not dot plots can be easily done in emerging market frameworks is a very intricate issue that you would have tremendous sort of market speculation based on the dot plots themselves.
See, I would fall back to, sorry to interrupt, I'll fall back to what Alfred was saying. Central banking and the guidance is also an art rather than science.
Absolutely, it is an art. I mean, in extraordinary time it worked. I mean, so let me say that even the initial time dependent guidance may have helped initially for some certain period of time. But what are the overall costs? And let's not say that the yield curve got flattened is the final objective of the monetary policy.
No.
So monetary policy's transmission has to complete on growth and inflation, and what is the evidence thereon. And the whole lot of unconventional monetary policy tools have been lauded excessively, especially by the European countries. But I think they still have to demonstrate how to exit out of UMPTs. Fed may have still done that a little successfully. The rest of the countries haven't really shown that path.
But agree with Sajid's point. I mean, you have to limit the number of objectives. You can't have central banks doing everything. Ladies and gentlemen, we are at the end of the, I don't have any further questions from our panelists. Yeah, we have Sparsh, our first colleague. Go ahead, Sparsh. You can shout, man, please.
So my question is...
Louder, Sparsh.
Hi, my question is to Dr. Chinoy. Sir, we saw that you discussed about that how there is a perfect conducive environment being made for private capex to kick in. The structural reforms, the supply side has been completely taken care of. It's the demand side that needs to come. We saw the period 2003 to 2008, as you also have been mentioning about it in a lot of conferences, that where we saw 9% growth that came in at the back of a very conducive external environment.
Short
that
questions, please.
That kicked in the private investment cycle. Do you think that with China plus one strategy and good domestic demand conditions, we can have a sustainable private capex cycle coming in 2-3 years?
Hi, my question is on the retail credit or low penetration of retail credit. I'm using credit cards as a gauge to see what is that. So today we have about 50 million credit cards, unique credit cards in India. So does it mean that we should look at as banks have been extremely prudent and not giving cards, or are they been very lazy and not allowing credit to happen?
My question is very different. The world is, I like to have the world IMF's opinion. The world is only looking at one molecule, hydrogen, to decarbonize the world. And hydrogen is not an energy source, it's only energy carrier. Are we not too dependent on hydrogen to decarbonize the world? To create 1 kg of hydrogen requires 50 kilowatt hours of energy. And it can carry only 35 kilowatts of energy. So almost only 60% of the energy that it needs to create it, that it can carry.
Thank you, sir. Our analysts are very, very knowledgeable, but I believe hydrogen might be
So, one question.
The question on credit cards could be answered quickly, that's possible, before we take the next one. That works.
So I'll try speaking loudly. Okay. So actually the household leverage in India is still low. So the household leverage is more like 35.5%, which is way below the global averages, way below the global averages. So you have absolutely the sort of point that maybe we can have more credit cards, more lending to the households and more sort of thing. But let us be a little cautious. See, we always get exuberant and say, okay, we are the fastest growing economy, we will become 5 trillion. We don't talk of the least per capita income among the G20 countries. So we still have to be cautious about what lending is not subprime and what could really be safe. So unsecured lending has to be balanced in a fashion while growing the market. Yes, there financial deepening has to occur. Financial deepening, if you see the flow fund data, I mean, we actually were growing very fast on financial deepening, and now we are plateauing it out at around 44-45%. So one other angle is that we have already begun lending more. If you see the financial savings side data, then actually loan side is increasing faster than the asset side, so that the financial saving is not really growing at the same pace as earlier. So those trends have already begun, but let's be patient that it is done in a more secured fashion. And I think more like a credit card company person, it's very important that you do a due diligence. Cash flow based lending is pretty reasonable in today's world, but that cash flows have to be reasonably, one has to be certain what the default rates would be and how this will work.
Dr. Sagar remains the cautious central banker. Alfred, please.
Maybe just one additional point. I think this is where the digital age ultimately helps. It's information asymmetry and having real-time data now, where people can, with pressing a button, get a small credit based on their past spending behavior. You have real-time information about default rates, so you can constantly adjust your models. So the potential to overcome financial sector asymmetric information through big tech, however you want to call it, is humongous. And I think this is where a lot more can be done. But then the flip side of that is again financial literacy, because people also need to be aware of the risks of borrowing, and I think more needs to be done, not only on the supply side but also helping those on the other side of the equation.
Yeah, one question, like lack of development in the corporate bond market, we sometimes call it that inappropriate pricing by the banks. It's more to do with the relationship banking rather than proper pricing. So now with the introduction of ECL, IFRS 9, do you think that it can propel corporate bond market development? Because the banks would have to maintain their capital adequacy, their overall provisioning as per the expected credit loss, would you think that it can make better pricing and ultimately it can actually complement bond market? My question to the panelists.
One more question, maybe we could take it. Vivek?
Hi, I'm Vivek Kumar. Two general questions for the panelists. Very short question. One is for Dr. Sagar, which is that we've seen active policy intervention in terms of controlling financial market volatility in case of India. So both in case of government bonds as well as in case of currency, the volatility that India has been showing is pretty low compared to its peers. So in some sense, you could say that the risk management that the markets would have done is getting outsourced to RBI. Is this something which is sustainable in the longer run? Would the markets become complacent if there is too much of intervention in trying to control volatility? Number two is on capital account liberalization. We did see a lot of that. But currently, in this kind of a global economy, we are seeing more current account restrictions than capital account liberalization. We are unfortunately moving towards that phase. So would a capital account liberalization go hand in hand with current account restrictions?
Sorry, I didn't get what current account restrictions we
So let's say
so
it's another form of saying that we are in a protectionist world.
Oh, the geopolitics of it. Okay, fine. To this I would straight away respond that this is something not good globally what is happening. So globally the world is regressing and one needs to get out of this sort of a mental framework where sort of geopolitics is ruling economics. About lowering of volatilities in these bond markets and the currency markets, yes, it has been done. It has been done through interventions at some cost. So it is not necessarily the best solution forever. Extraordinary situation demands extraordinary sort of solutions, which has been sort of, we have lasted the pandemic. We should get out of pandemic mold. We should get back into more market-based pricing. I think more hedge products are already available. It's for the markets to do their jobs, and that should be something good. About capital account liberalization, I think the agenda is unfinished, but a lot more has been done now of late. Some steps were taken even during the pandemic, especially on the offshore side. I think the country at some stage needs to move out of and do a massive forex liberalization. The underlines kind of restrictions don't make sense to me because virtually they are gained. So we have to move out of that framework. What is the right time one has to choose and what pace of steps can be taken? I'm sure the regulators will be thinking on those lines as well and doing something in due course.
Thank you, Dr. Sagar. We'll take the absolutely last question for you.
It's a fairly short question. We heard so many good things about the development of the Indian economy. When is the sovereign rating improving? Yeah, yesterday only Fitch kept it on hold. It should happen within the next coming months or years, perhaps.
We have people from credit rating agencies sitting right here. No, but you could take a stab at it. I'm not sure we'll have an answer, sir. It's for them.
I'll just answer the first question for 10 seconds on the
please.
capex cycle. Thank you for that elegant question. No, just to say, if we were having this discussion 3 years ago, 5 years ago, 7 years ago, it would have been impossible to get through 15 minutes without the word twin balance sheet problem being spoken multiple times. And the fact that we haven't mentioned that once in the last 2 hours is a testimony to how far we've come. Not to overstate the case, I think, as has been shown, both sides of the balance sheet are much cleaner, banks and corporates. But the fact is no emerging market has grown at 7 or 8% for any length of time without strong export growth, right? Unless you're commodity endowed. Right? And you pointed out the fact that between 2003 and 10 it was 18% a year export growth that drove the investment cycle. Investment is endogenous. It needs final demand, right? If you think of CIGS, it needs X, C or G or X. And the problem is we're in this world where you've got increased protectionism, economic balkanization, so you won't be in a situation where a rising tide is lifting all boats. You've got to do the harder work of increasing your global market share. Now the good news is I think several stars are lining up. You spoke on the manufacturing side about, you know, China plus one and friendshoring, and that's a unique once in a 40-50 year opportunity. So hopefully we can keep plugging away and get our share of FDI and join global value chains. The other exciting thing that we haven't spoken about is what's happening on the services side, right? That not just software services but non-software services, the growth has been incredible. You've gone from $85 billion net service export number in the balance of payments to $150 billion in just 2 years, right? I say this again, you know, if you watch a Marvel movie now, 35% of the names at the end of the movie are Indian names because all the automation.
Ajit, my kid and I do this.
Sorry?
My kid and I do this. We actually go at the end of the credits and we see how many Indians are there. All the VFX names are Indian.
Exactly, and this is happening in Bombay, in Hyderabad, in Pune. So there's a real chance here that India could well become the office to the world, right? That at a time where immigrations become toxic, you can do this services because of increased digitalization sitting in India. The only trade-off here is that's going to help the white-collar workers at the top of the pyramid. And therefore you also have to have the manufacturing push for the blue-collar workers at the bottom.
Thank you everybody. We are at the end of our panel discussion. I hope we left you yearning for more, and that kind of gives me a good feeling. Thank you so much. Thank you Nada, thank you Alfred, thank you Dr. Sagar, thank you Dr. Kumar. Thank you.
Thank you everybody, all the panelists. It was truly an engaging and stimulating discussion, and I'm sure we are all yearning for more, but moving on, probably we can take it, you know, outside. I would request Dr. Patnaik to felicitate all the panelists with a token of our appreciation. So, Dr. Nada. Dr. Alfred. Dr. Sagar. And Dr. Chinoy.
Thank you so much.
Thank you very much. As we come to the end of today's event, it gives me immense pleasure to propose the vote of thanks on behalf of NSE to each and everyone whose contribution made this event a success. First of all, we are extremely grateful to IMF for agreeing to organize this event along with us. I thank Dr. Nada and Dr. Alfred for a very insightful presentation, and special thanks to Dr. Louis Brar for his support and Sudeep for your cooperation to organize today's event. My heartfelt thanks to all our panelists for graciously accepting our invitation to participate in today's discussion. Your incisive views and comments have made today's discussion truly memorable. I thank our members of the media for covering today's event. Last but not the least, I thank our audience members who have joined us here at NSE and online for their participation. We truly appreciate the support and cooperation we received from our colleagues at NSE, including Mr. Sriram Krishnan for organizing this event. Thank you. I'll not take long. Dinner is served. We look forward to hosting you again, and I request all of you to join outside.